Hello, I'm David Frazier, the founder of Investors Monitor and the president and chief market strategist for Frazier and Mayer Research LLC, our independent investment research firm. This is the first in a new series of videos that we plan to record every week regarding factors and developments that will likely affect the worldwide financial markets, as well as our listeners' individual investment portfolios. In this first video, I'm going to discuss briefly my outlook for the stock market during 2018. However, before doing so, let's very briefly review the past year, 2017. Well, we had a really good year during 2017. The Dow Jones Industrial Average was up almost 5,000 points. The S&P 500 Total Return Index rose by approximately 22%, and the NASDAQ Composite Index was up approximately 28%. Our proprietary Investors Monitor 20 Index, which is composed primarily of small cap growth stocks with a lot of technology stocks during the past year, and which is displayed on the homepage of our internet website at investorsmonitor.com. Our IM20 index rose by 79% during 2017. And many stocks that we covered last year were up more than 50%. Several more than doubled, and two stocks that we covered actually tripled during 2017. So 2017 was a very good year for people that put a large amount of their money in the U.S. stock market, and especially if they put that money in the right stocks. Now, why was 2017 such a good year? Well, it's pretty simple, I think. It had a lot to do with the expectations regarding a tax reform bill, and a lot to do with a lot of deregulation of U.S. government businesses. And by the way, during May of 2016, in a taped interview that I did with another firm, I said that I was convinced completely that Donald Trump would win the election during 2017 and become the 45th U.S. president. And boy, did I get a lot of ridicule and a lot of laughs regarding that comment at that time. I mean, people almost dropped out of their seats. And I was completely convinced. And the reason being is I simply did a lot of research and paid attention to what people were saying and thinking in various U.S. states across the country, mainly in the breadwinner states, or the farmland, if you would call it, not the breadwinner, the bread producer, I guess you would call it, states, the farmland states, as well as in Rust Belt states. It was pretty clear to me that those people in the aggregate were going to vote for Mr. Trump, and they did so. And that was very important for the reason that I just stated, or reasons, and that is Mr. Trump, at the time, now the president, was calling for a lot of deregulation of U.S. businesses, which actually occurred during 2017, and was proposing that there be a lot of tax cuts or improvements in the U.S. tax code. So people's were very, very positive, and their perceptions were very optimistic regarding the year 2017. So that's primarily why stocks rose. I mean, I'm often amused, or was very amused during 2017, in all of the discussions by a lot of so-called experts saying that stocks are way overvalued and therefore are due for a huge pullback. Well, the fact of the matter is, stocks were, on a fundamental basis, overvalued during 2017, at least a lot of stocks. And for our conservative clients and people that are focused primarily on preserving the value of their capital, of their investments, I was pretty cautious in the recommendations that I made to those persons because of the high stock market valuations. But few people ever buy a stock because of market valuations or individual stock valuations. Most people, in fact, I would argue almost everyone other than value investors, never buys a stock based on fundamental valuations. They buy a stock simply because they think the stock's going to go higher. And oftentimes, the reason or reasons that they think that a stock is going to go higher is simply because the stock performed very well during the prior several months. Now, that might not be a good reason to buy stocks. Just, stock, they're buying it just because it went up recently. But the fact of the matter is, that's oftentimes why stocks do go up. But there are numerous other factors that affect people's perceptions regarding the financial markets or anything in life. And that had a lot to do with the reason that stocks did well during 2017. Now, by the way, did I get everything right during 2017? Of course not. For example, I was expecting to see a pullback in the stock markets around the globe, really, but especially here in the United States during the fourth quarter of 2017, because my research indicated that stocks, many stocks at least, had just risen to very extended levels, and therefore we'd see some selling. But that did not occur. So, fortunately, though, I and my firm, we did get most things right during 2017, and the election leading, whatever. I just said what they are. So enough about that. Let's move ahead. What do I expect to occur during 2018? What's my outlook for 2018? Well, in my opinion, based on a ton of research, as well as regularly monitoring the trading action in stock markets around the globe, my opinion is that stocks are going to continue to move higher during the first half of 2018. Now, once again, we've had a lot of talk about stocks are way overvalued. No, that's nonsense. That's not what drives stocks higher. But we have also had many so-called experts and many other people say, well, we're going to be going into the 10th year of this bull market. Aren't we very late into the game? And I would say, no, we're not. And the reason being, I would argue that the bull market that began during March of 2009 actually ended during during July of 2014. That is, that the bull market that began during 2009, March 2009, I would argue, once again, ended during July of 2014. And I mean, if you look at a stock of the major stock market indices, well, that is what occurred. Because then stocks traded sideways for about a year, and then they pulled back considerably for several months. I think it was, I don't recall. I think it was during January and February of 2016. So I would argue that the current bull market actually did not begin until late February, early March of 2016. Well, if that's the case, we're in the very early stages of a bull market. And the recent relative performance of the 10 major economic sectors, stocks of companies that operate in the 10 major economic sectors, seems to confirm that we're in the early stages of a bull market. And what I mean by that, generally speaking, in the initial phases of any bull market, technology stocks tend to be by far the best performers. Well, what were the best stocks last year? What were the best performing stocks during 2017? Technology stocks. But over the past few weeks, industrial stocks and basic material stocks have been the top performers. And, well, what generally happens then in the early stages, not the initial, but the next phase of most bull markets, up and through the middle stages of a bull market, what generally occurs regarding which sectors of the market perform best, and it's the industrial and basic material stocks. So I would argue we're in the early stages of a bull market. Now, there appears to be no immediate catalyst to propel stocks higher. And what I mean by that, well, the tax cuts that people were very optimistic during 2017, well, that has now occurred with President Trump signing the tax reform bill on December 22nd, 2016. However, there's a very likely new developing catalyst that's already begun, and that is Mr. Trump's, or President Trump's, I guess I should say, proposals regarding infrastructure spending. And there's already discussion, about a focus now being on infrastructure spending. Now, whether or not we're going to actually get substantial spending and investments on infrastructure projects, I don't know. But what I do know is, once again, if people believe that that's going to happen, if people are optimistic, if they perceive that it's going to happen, then, well, there's a new catalyst for you. And sure enough, today, on Tuesday, January 2nd, I don't know that they were the best performers, but I saw several infrastructure stocks move up considerably today. So that, in my opinion, is going to be the next catalyst. Now, when we get into the second half of 2018, I think there's a good chance that we'll see a pullback in stocks. And why is that? Well, it has to do with inflation rates, inflation expectations, and interest rate increases. Now, there's been a lot of talk about, if the Fed rate starts raising rates or raises rates substantially, won't that cause stocks to fall? And the answer is, historically, early rounds of Federal Reserve rate hikes have not deterred stock market participants in any way whatsoever. And that shouldn't be surprising, because when and why does the Federal Reserve raise its overnight lending rate, the target Fed funds rate? Well, when they see improvements in the economy. And by the way, I get also amused by whenever anyone talks about interest rates and the Federal Reserve, they always say the Fed raised interest rates or lowered interest rates, whatever they did. Well, the Fed does not raise interest rates. That is in the plural. It determines only one interest rate. That is the overnight bank lending rate, the federal funds rate. Now, it's true that debt securities with maturities of 2 years or less tend to move in the same direction as the Fed funds rate. However, longer-term rates generally are not affected by what the Fed does. Longer-term rates are determined primarily by people's expectations regarding inflation. And the reason that I said I think we might see a pullback during the second half of 2018 is because if the economy does continue to expand at a fast rate over the next several months, and I think that's going to occur, then people will start to think that inflation rates are going to increase, and they probably will increase. So then the Federal Reserve, I would argue, there's a good chance will, around June or July of next year, start to raise its overnight lending rate substantially, and longer-term interest rates will also start to rise substantially. And if that were to occur, then my thinking is we'll see a pullback in stocks because of the ways in which substantial increases in both long and short-term rates generally are negative for corporate earnings and therefore for stock prices. So I thank you for watching and listening. I hope you've learned something, have gotten something out of this video. As I said in the introduction, we plan to record these videos every week on Saturday or Sunday of every week, and to post them to our website as well as to our YouTube channel at Investors Monitor is our YouTube channel, and our website is investorsmonitor.com. We plan to record these videos every Saturday or Sunday and post them to those sites on Sunday of every week. If you would like to stay more abreast of, in a more detailed way, of factors and developments that are likely to affect the financial markets and your personal investment portfolio, then I urge you to try one or more of our investment journals. We have 2 journals, Frazier's Strategic Allocator, which is somewhat conservative in its approach and its recommendations, and it focuses a lot on preservation of capital. We cover 3 model portfolios in that journal, meaning we make recommendations on 3 model portfolios, a growth in income portfolio, a fixed income portfolio, and a speculative portfolio. However, if you are more of a risk taker, or more of an aggressive investor and speculator, you probably should try our Frazier's Exponential Growth Opportunities publication, which focuses on small cap growth stocks. Stocks are companies that we expect to increase by up to 30% in only a period of 3 months. And by the way, we've done that many, many times in the past, so do not think that's unachievable. And stocks that we expect to double within 12 to 18 months. You can try either of those publications or both of them if you want by clicking on the link that's provided beneath the video box of this video, right underneath that video box. It'll take you directly to our subscription page, and you can subscribe for the next 3 months to Frazier's Strategic Allocator for only $79 for the next 3 months, and to Frazier's Exponential Growth Opportunities for only $99 for the next 3 months. So once again, regardless, I hope you tune in every week. As you can tell, I'm in my facial expression, I tend to be very serious about the financial markets and our discussions and our recommendations, and very passionate about the financial markets. And so I don't smile or laugh a lot because I am so serious. But thank you once again. We hope you tune in again this coming Sunday.